Hello, warriors. Let the market come to you. Okay. How you doing, Alexander? Steve, Mike. Hi, Blake. Paul Nash, how are you? K-Man's here. Hugo. James Groom. Hi, Bran. Adam. Adam, welcome to F.A.C.E. Okay. So steady dollar. What we have going on. Not sure. It's holding where it had to from last week. I think there might be one more dip coming though. So anyway, here we go. Gold down pretty hard, 42, silver down 55. Don't blame me, blame it on the moon. Okay, that's a Bob Seger song, I believe, as well. Blame it on the moon. So it looks like we put in some type of high into the lunar cycle. Silver takes this out. The people that want to buy it at 5.5, I think they're going to have a chance to do it. And so far, it's doing it without a real strong dollar. I mean, it's up, but I mean, this almost looks too easy, doesn't it? You just bought it right back at the breakout with confluence of the moving average there. Acting okay. So I thought there might be a high coming in S&Ps, but they were lower. Now they're higher. I'd still be alert for something like that. Perhaps we're not going to make new highs in the S&Ps. Nasdaq's pretty close. Anyway, we have the whole team here, and those are my impressions. I was pretty bearish the metals, and actually held down to some silver from 42, 38, 42. So this is a big level for silver. We'll see if it could hold it. And why don't we start off with Ryan? Good morning, buddy. How are you?
Morning, sir. So we're blaming it on the moonlight, not the boogie.
Yeah, blame it on the moon. I mean, people laugh at it, but I'll tell you something, Ryan. I've seen it many, many, many times, not like once or twice either. Okay, so sometimes when markets are on fire or they're in trouble into these full moons, I've seen many turns over my career. So, I mean, it still amazes me, but there's something to it. I mean, the whole thing was done by a mathematician with cycles and everything. So, I guess you could look at anything. Even Steve, are you here? Even the planets you could look at to trade. Anyway,
Oh, you're lucky he's not here.
Yeah,
Steve, I'm an astro guy now. Fire me.
Running out the door.
Anyway,
There was a big ass moon, and it wasn't like anybody's
yeah,
buttocks either. But that over the weekend, it was huge.
yeah.
Yeah,
See,
beautiful.
yeah, I've always had a fascination with the moon. So,
Dale, why don't you come over here? I'll show you a full moon, buddy.
not those moons, bro.
Oh, okay, all
Before
right.
breakfast, anyway. So, what are we doing with the dollar here? Start off with Ryan. What are you doing? I know you're long EG.
Yeah.
What are you doing? Are you doing anything in euro?
No, not at the moment. I'm going to watch the CPI data tomorrow. I'd like to see maybe if we get a hot number, maybe we get another look down at that 115 level, see if that holds.
Okay.
It seems to hold around the, 25, 30 area before you get a move, before we had that move down into the 114s. But I think the CPI data is probably going to be what everyone's waiting for. It's going to be potentially a big number because it goes with the narrative of the Fed, why they're staying on hold. Inflation is expected to tick up, I think, for the fourth month on the trot. And then we might see a bit of an unwind of the jobs trade that we obviously saw after the NFP. So it's in a little bit of a flux at the moment. Yeah, those yields are important. I said all last week. I'll be if I'd be lucky if we saw them getting back above 430, and they seem to be yields seem to be getting attacked every time they get up to that area. But as you can see from that chart, they're grinding back away from that 420 level, which will make the level important again.
Yeah, real important.
Yeah.
So here and here. So okay. You think there's so I mean, could there be a surprise and we get back above 430 and make one more run towards this 445 level? I mean, I saw a count, okay, it's not my work, that actually has the 10-year spiking to 475 before the big break in interest rates. One more, like, hurrah, I forgot what the formation is. Some type of Elliott triangle or something.
Well, irrespective of that, I think it's possible. You know, if we get a real hot number, and then we get another hot number the month after, you know, we'll probably be up at the very least testing that 450 again, because the market will be going, okay, the Fed's in a pickle, inflation's ramping higher. Is the jobs market wobbling? We won't know till the next number. And if that returns back to growth in the NFP, you know, we get a 250 or something and the revisions get revised the other way, then it's holler dollar and yields will be up and dollar will be up and the panic will be over. So yeah, it's the
There's
good thing
a big
is,
picture right there.
Yeah.
So that'll be the upper trend line about would this be 470? Yeah, 475 right there.
Yeah, thereabouts. And you know, you won't blame the market. You wouldn't blame the market for going there. But then you have to remember that the Fed still wants rates down. So you know,
the Fed does, or Trump does.
Well, the Fed wants them down. They don't want to be running rates where they are now, and Trump obviously wants them down. But if we're sailing up there, you're probably gonna have some in the market who will be touting for a hike. You know, if we get 2 more months of much hotter CPI, so it's trending up at 4% or something.
Yeah.
Then you know, someone's going to be starting to shout for hikes, and that'll get you 475, 470.
Okay, so that could be behind maybe the next wave up in the dollar if that happens.
Absolutely.
Okay.
Absolutely.
103. You know, and then rates start heading down and the dollar sells off again. I think this would be enough to squeeze out some people that are bearish a dollar up here, don't you?
I think if we're up there, you're probably going to get even more people being bullish a dollar. It's
No, I'm talking about the bears.
The bears.
Bears out up there.
Oh, they'll be running for the hills, mate. They'll be looking to hibernate again for another 6 months.
Okay.
It could be the perfect storm this week. You know, we get hot CPI, and then we need to see this US Russia summit on Friday. You know, if we get something really positive from that, that's going to be good for risk. It's going to be good for the euro, but it also might be good for the dollar in the global picture, because that'll be a big risk element removed. And yeah, so you know, and it's the perfect storm: hot CPI, risk removed, followed up by a better NFP, and all of a sudden the US is the best economy in the world again.
Okay. Commodity currencies, any comment?
Yeah, I mean, dollar CAD, I'm still long a little bit of this one. It held my 137.20, 35 zone pretty much on the nail. It's pushing up. I think it's got a bit to do to keep going. 138.10 was those prior highs.
Yeah.
And again, it's in the mix. What's going to happen with oil? If there's a resolution, do we see prices coming off and dollar CAD rising? So that's another important thing to watch. And aside from the dollar side of things, the US dollar side of things, what happens with this data?
Okay, so really the CPI is that Thursday?
Yeah, CPI Thursday, but we also got retail sales, US retail sales on Friday. So you know, there's 2 really important data points coming.
CPI is tomorrow, guys.
CPI tomorrow, yeah. Retail's Friday.
Okay, man, you doing anything with the crosses or the yen or?
What am I doing? I just one thing that I immediately noted this morning and spoke about it in the flow show as well. I think tomorrow a pretty big day for the cable because we have the UK jobs report and the US CPI. So that should be getting the cable to pick a side. So your red line also coincides with a resistance that I have just around 135. If ever that would break on better than expected UK jobs and maybe a slower CPI than expected, that could be setting off the next move. And downside, there's that big 133.65.75 still. So
No.
tomorrow, really, I'm going to be at least for part of the day concentrated on the cable. Cross sides, yeah, I'm still long Euro Swiss. That's finally starting to go somewhere. And
How
to,
about silver? Where's your buy point?
oh yeah, we didn't have the time to look at much of that on the flow show because we were running a bit. It's broken a little. Well, it's very close by the 37.85.90. I think we could potentially have a look at 37. Start with 37.30 and then perhaps that I've got a zone there around 36.80. 36.80 would really raise my antenna if we get down there. I may start to add again, starting there, and then obviously, the closer we would come to 35. I mean, 35. I'm going to close my eyes and load them up. But yeah, gold is coming back quite a bit. I think finally the market maybe understood what is happening or may not happen with that whole gold US thing, Switzerland, etc. Took Friday and to figure out what was going to happen, maybe even a mistake. So gold is coming back down. I think that we could actually get down to low 33s again before looking back. I'm quite interested maybe in the 33.10.25 zone personally. But I'm less, let's say I'm less in a hurry on gold than I would be if my levels are reached on silver. I still think that silver could outperform gold, and think about then the end of the week meetings, whatever, any positive outcome, and silver should really outperform gold there, I think. But that is not a done thing, in my opinion. Yeah, for the rest, trade it as it comes. Trade it as it comes. I think tomorrow RBA or late in your evening RBA should be doing 25. I'm joining the majority to expect it, but then we will see whether it's I think a neutral 25 coming. And all in all, perhaps on the crosser side, Aussie still doing okay-ish. That's what I'm kind of thinking.
Okay. All right. Well, I appreciate it, and so does everyone else listening. Blake, you want to interject and talk about what some of your game plan for this week?
I was
Raise your
talking.
hand.
I was talking and into the microphone that was
Muted.
muted.
Okay.
Yeah, I'd love to. First and foremost, I was just talking about some of these Euro crosses, and I'm gonna go back to the Euro Swiss just because obviously, if you guys been watching the week ahead videos for the last couple weeks, it's one of my trade setups for this week and a breakout above, I mean, it's been actually on my radar literally for the last month and it's breaking out. It's at really big resistance, and if we start clearing above 94.50, we're looking at harmonic patterns that could take us to 95 cents beyond that. There's so many reasons to be short Swiss francs, in my opinion, at this point. And the only thing that's going to change that is if you do, or if Switzerland does secure some sort of trade deal, and I don't see that happening. I would assume that President Trump's gonna, keep their feet to the fire at least for a while until they could get a better deal, especially in the pharmaceutical space. So actually, the Swiss government reached out to Novartis and and Roche over the weekend to discuss the tariffs that are coming, and basically, so the Swiss government's going back to their two big players and trying to talk it all out, like what it actually means for the industry, which is huge. I mean, that's something that, obviously is getting some attention. When you talk about the dollar, I think the dollar still has room for recovery, and you got the euro that here, let's pull it up here. Euro's trying to roll over a little bit. We do have inflation data, obviously, tomorrow. As these guys mentioned, we have retail sales at the end of the week. We have producer prices on Wednesday, and then on Friday we also have University of Michigan consumer sentiment and inflation expectations, which is going to be another big mover. And these are the types of weeks when it's really illiquid. There's not a lot of players. It's kind of like that. It's kind of like the couple weeks right now. It's very similar to the couple weeks just before the Christmas holidays. When you're dealing with at the very end of the year, a lot of thin markets. So traders are all obviously yearning for data to press to press the market a little bit. And we just need a catalyst. We just need some data that comes in a little bit
Well,
beyond expectation.
well, remember last year we could have said the same thing, except the exact conditions that you describe leave markets vulnerable for raids on both sides.
Exactly.
Last year we had the bear raid because of the unwind of the carry trade in August,
Yeah.
if you recall. So, I mean, you still have to be on your toes in August. Don't just like sit back in your lounge chair and think everything's, going to stay the same for the rest of the month. So,
Yeah, exactly. There's so many moving parts and so many variables that are happening right now. So absolutely. If you just looking around though, I mean, there's so many currencies near key levels. One of the ones that I did talk about on the week ahead video, and I want to discuss today is Mexico, or the dollar mex, and you can see how we're by really critical support around this 1850 level. I think it looks very vulnerable should the dollar see some further downside. However, because there's actually a big article over the weekend in Bloomberg talking about carry trades and the mentioning the peso and the Brazilian real. Even though, I mean, what's the interest rate differential between where the U.S. is at and Mexico? Maybe 3% now. I mean, it's not very high. But there are other emerging market currencies that are doing much better, which like the US dollar BRL is, is one of them in particular. And I think the dollar mex is just along for the ride. But I'm actually looking for levels below 1850 to be on the long side. Again, I explained that in the week ahead video at the longer term 618 retracement is where I'm looking. So I think that's going to be really interesting. But you said it just as we started, Dale, and this is something that I accentuate. I've pretty much done it every day for the last three weeks, maybe or so. During our other shows, is just talking about, I call it target trading. Where you just are looking at certain levels to be long or short, and only play at those levels. I'm going to talk about something else really quick, just because we've got a full house. Well, as many people are going to be here on a summer Monday. I want to talk a little bit about the Gelber Group doing the breakout. This is going to be this is the second breakout, and we're going to have an interview with them on Wednesday. So that means on the 12th, 13th. Okay. So on the 13th, on Wednesday, right after Dale's interview, we're going to have the guys from the Gelber Group out of New York. They're going to come join us again. It's the new, and I'll put it right here, guys. I'll put it in our chat box so everybody can that's listening in via Zoom, which hopefully you are. You'll be able to you can read that. This is their second time they're doing this, and there's a reason why I'm telling you guys this. All right, not just because I'm telling you about the breakout. This is how you could actually qualify to be a trader at. This is one of the top prop firms in the United States, I would say. They have a couple locations in the U.S. One in Chicago, one in New York. I know several of the traders from this New York operation. Matter of fact, my my son's girlfriend's dad was the head currency desk trader at Morgan for 25 years, and he knows Tommy, who's going to be on Wednesday, and Tommy P or Tommy Peltier. Him and I text all the time. Great, and he's actually jumped in our chat room a couple times this last week. Just really, really good group of traders, but you can't just join this group. You actually have to, join this competition. You have to submit a couple years worth of trading results. And then you got to do well in this competition. I am going to be competing with you guys this year. I'd competed last year too. I think I got 8th out of 40. I am going to compete and actually try this year. So. But the reason why I'm telling you all this is because I found out something interesting because of the way, just talking about target trading. Last year when we were doing this competition, I was learning this new platform that I've never used before, that they were using, this institutional platform. And I'm like, hey, how do you, I was asking, like, how do you do, how do I do market orders? And then I asked Tommy, I'm like, how many people use, or how often do people use market orders? He's like, maybe less than 5% of the time. Most of our traders are, they put in limit orders and they buy where they want to buy and they sell where they want to sell, and that's it. And that got me thinking about how many traders that are listening in right now, they see the market moving and they're like, I'm buying at market here, I'm selling at market here. These guys basically wait for prices to get where they want to be involved, and that's it. That's what he was telling me. He's like, 95% of the time our orders are just out, and when the market reaches for where we want to be involved, we get in. They're not using market orders to get in or out, and that is funny because that is a characteristic that was pretty prevalent in the firms that I traded for as well. So think about that in your own trading, target trading, I was just telling the guys in the chat room, if you're not in the Forex Analytics chat room, you just come over here and you can see I was pointing this is the Euro Sterling, and I'm like, this is a cipher pattern. I'm like, I want to be a buyer at 86.40. I have my bids out. And as I was telling K-Man just a minute ago, I said, I have an order out at 86.41, and that's going to be it for me. I'm getting in where I want to get in. I'm not going to just start buying here because randomly it seems like a great price to be long. No, I'm going to get long where I want to get long. And that's that could be the differentiator for you as a trader and your success rate as a trader. So think about that. Think about what I was just saying here.
Who's it open to, Blake?
What's that?
Who's it open to? Is it just
not you? No, they don't open it to people that are on holiday 9 months out of the year, buddy. Sorry, you actually have to be in front of your desk.
And can't trade from the beach. No, but seriously, is it just
seriously, I believe, and I'm gonna confirm this. I believe it's just North American traders. Last year they said they were going to try to open it up to outside the U.S. The problem is their compliance. They have a pretty how should I say, big compliance department, or they have a very strict compliance department. So there's certain things that they're trying to avoid. They don't want to get in any hot water. Let's put it that way. Does it make sense? But I'm going to confirm that. We're going to confirm that on Wednesday. Regardless, you guys should check out what they do. The Gelber Group, have you ever read Market Wizards, the original? in 1989, I believe. Dale, is that, I have to, my book is right over here. I have to go back and look. The original Market Wizards.
Not quite sure.
I want to say it's 89, but I'm here it is. Let's see. I'm just pulling it up right here. The original Jack D. Schwager. This which year was this? This one anyway. 93. Release date is 93. I thought it was 89. Brian Gelber is one of the traders in here. He is. If you want to, whoops, I should have hit leadership. That's Brian right here. He's one of the main guys that's started the Gelber group. They're legend. He's a legend. Their group is legendary too, especially if you're out of New York. You'd be very familiar with who they are. So yeah, Ryan, I wish I had a better answer for you.
No, that's all right. Just want to make sure you don't want 100 people from Europe applying if they can't get in.
Yeah, we're gonna find out for sure. But yeah, they're you know they're obviously very picky about who they bring along. But it's quite an amazing situation when you trade for companies like this. So they'll be like, you know, and I don't know the number specifically. Well, actually, I do, but I'm just going to give you like a roundabout number. You know, they basically give you a max loss that you have per month. Like, you know, hey, you can risk $500,000. You know, we shut you down after that. You know, they give you those types of limitations, but that's pretty much it. You know, you have to pay for your own Bloomberg. It's $2,800 out of your bottom line, but it's how they, you know, I had to do it, you know, but it's how they can, you know, track your trades and, you know, make sure that their compliance people are staying up with you and their risk management, yada, 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 all that other stuff. So anyway, yeah, so check out Gelber Group and check out the breakout. It's coming and hopefully it's open to other traders. Anyway, we just got a couple of minutes. Ryan, what are you looking at this week? Anything in particular?
Yeah, I'm looking at what mess we're going to be left by the end of the week. We've got these big events. We got the data. There's UK data tomorrow. We've got the RBA tomorrow, which could be another funky one. I was looking into that and how they've changed up how they do things. So a bit like the Bank of England, you need to look at the votes because they voted 6-3 to keep rates on hold last time, which was a big surprise to the market, who was expecting a cut, and we're expecting a cut tomorrow. So there is a big risk that they pull the rug again, like they did last month.
Yeah. Yeah. And, you know, Sterling is still, I mean, it's still not looking bad. I mean, it's not looking bearish. Go
No,
ahead.
it's not looking too bad at all. We've got jobs data tomorrow from the UK, GDP, trade data later in the week. So it's gonna put the Bank of England's message to the test starting tomorrow. So if we get a soggy one from the jobs data, then the pound will probably go back to being the whipping boy.
Yeah. K-Man, what you thinking this week?
Well, yeah, as I said earlier, sterling for sure, Aussie, and what else? I find it pretty telling that the yen can't strengthen, and so I'm maybe looking on any bout of yen relative strength to perhaps get into some short yen again, because it's just if when I look at those crosses, they see some retracements, but never deep enough to really go to really step in, and that tells me that there's still people looking at the other side. So yeah, yen is one of those.
Yeah, look at the euro yen here, like firmed up. I mean, that's it looks like
Yeah,
it wants to break higher.
I thought this morning that was giving way, and so because I was a little long, let it go, and it's holding, it's holding.
Yeah. All right. Well, hey guys, if you haven't seen, I mean, the Bitcoin ripped past the 618 retracement. I mean, it was you know, stalling up here against the 19,000 level over the weekend, and then last night it just just took off on Sunday. But we might be creating a lower high, which, you know, if you look kind of out in, you know, longer term in Bitcoin, we're just, you know, challenging, you know, these trend lines up here. But man, Bitcoin's strong. I mean, crypto looks great. You know, look at Ethereum. Ethereum broke out. I mean, there's some pretty big moves here. I don't know if that was a short squeeze or what, but something worth noting, I
You
think.
know, I saw some work that shows that Bitcoin and gold at times trade opposite of each other. So a strong Bitcoin market has translated into weaker bullion prices, and
Interesting.
several inflection points I saw.
Okay. Well, you know, and gold is it is I don't want to say it's, you know,
Oh,
it's
blame it on the
bearish.
moon.
Yeah, we'll
Blame it.
blame it on the moon.
You
We'll
know
blame it
what?
on
I've been asking this question to everyone I've had on. Why is this? How do you know this is consolidation and not distribution? How do you know?
you don't. You'll
But
know
everyone's saying it's
once it breaks.
yeah, everyone's saying it's consolidation. Everyone.
Well, yeah, but I mean, we're consolidating at all-time highs. It's not bearish, but yes, it definitely could be distribution. I mean, this could end up being, you know,
Yeah.
a Wyckoff distribution pattern for
Oh,
sure.
there you go.
You
Wipe off.
know, yeah, I
Yeah,
mean,
I like
it
that.
could be. Hey, Dale, is your guest here today?
Yeah, Michael is here. I can't
Oh, you
promote
know what?
him.
I didn't make you host. I'm sorry.
That's
Let
all
me.
right. Mike Kramer's here.
Okay,
And
got him.
you, yeah, and he's got some real interesting stuff on the stream that I want to talk to him about. So
All right, that was my fault, Dale. My
that's
bad.
okay. No
All right.
problem.
Well, hey, I want to say, and Michael should be coming over right now. He's over. All right, guys. I want to just say, you know, have a great week. Make sure you take advantage of our sale. That's the 40% off. We have a lot of people locking in low prices. Do it while you can, because when we remove this, we'll remove it and then it's gone. Then, but if you're locked in, you're grandfathered in. So take advantage of it. And Ryan came in. You guys, I was trying to listen to you this morning. You know, at the Flow Show, everybody should be listening to the Flow Show, even if it's not live. Listen to the recording if you're getting up a little later, like myself. Dale, have a great interview with Mr. Kramer, and
Thank
thank
you.
you guys for being here today.
Yeah,
Cheers,
thank you,
everyone.
Kate. Thank you, Kay, man. Thank you, Ryan. Thanks, Blake. All right, so the beginning of the week, what a great guy to start the week off with. Mike, how are you? It's great to have you back. You're
I'm good. How are
unmuted. There,
you?
there. Good, man. So, you know, I watched some of your videos.
Yeah,
Yeah, and you really cover a lot of things that people aren't looking at. You really look at beneath the surface stuff and a lot of things on swaps and
sure.
rates, and you go over all the news. And I saw something in one of your Twitter, I think a tweet about, or it was a video about how financial conditions are tightening or there's a liquidity drain
Right.
happening at this time. Can you tell us what you're seeing and
Yeah,
show
sure.
us?
I'll let me just share my
Because
screen.
it's certainly showing up in the gold market today. If
Yeah,
there's a liquid,
it's gonna start showing up in a big way in all the markets over the course of this week, I think.
okay.
Um, so
You're looking for some hot numbers on the inflation numbers.
um you know that I'm not seeing anything that suggests that the inflation numbers are gonna be hot. Most of the data points I'm seeing are, you know, based on the swaps markets and based on some of the betting markets, are
Yeah.
that numbers are going to basically be in line. I mean, if you
Okay.
look at the, I think it's more about, you know, where inflation is going to be going from here. And based on where the market is, it's, you know, we basically have inflation expected to rise to about 3.5% by the middle of next year.
Right.
And so this it's really more important, I think, from a standpoint of this number this week, is that these numbers don't surprise to the downside, right? If these numbers just come in line, then you know everything's kind of on target for where the market sees rates going, you know, inflation going. Obviously, if they come in hot for some reason, um, then you're talking about the market probably upping its expectations on where inflation's going, and that would shift things, I think, in a more meaningful way. But I think over the course of the next couple of weeks, we're talking about the potential for, basically a draining of liquidity. And it was interesting because I saw the chart of Bitcoin as well over the weekend, and I saw it was going up, and I'm like, oh, like doesn't make any sense to me. But essentially with the passing of the debt ceiling, the Treasury now has to refill the Treasury general account to about $850 billion by the end of September. So the Treasury general account right now is this dark blue line down here, and it's sitting right below 500 billion. And that number's got to obviously rise another 350, 400 billion, depending upon how, this takes place, to get us back up to this level in here. And historically speaking, when you look at changes in the Treasury general account, it tends to coincide with liquidity coming out of the equity markets. And you'll see that, stock market has tended to move lower during that periods of time. A lot of people are kind of under this impression that, maybe it doesn't matter, because in 2023, when the TGA was being refilled after the debt ceiling, it only had a partial impact, only about a 10% decline in the S&P 500 from it. But I think what was important is kind of, an oversight, is that in 2023, at the same time, the TGA was refilling, we had the reverse repo activity coming down. And that was adding liquidity to the market. So if you take this number and you just invert it, if I could figure out how to, this is all new to me. So this is a new product I'm using. But if you basically invert it, it will, you'll see it basically. You see how it looks like the S&P 500 then?
Yeah.
So the difference between now and then is that the reverse repo facility, which is a number the Fed puts out every day at 115, is basically drained. There's no more excess liquidity in the marketplace.
Mike, there was a story about 3 weeks ago about someone having to go the window for this exact reason. And someone was saying, it had happened with this amount of size for many years.
Yeah, the $11 billion.
Was that so? Did that catch your attention too? And now with what you're seeing continuing to occur, is why you're kind of putting the yellow light out there, the caution light.
Yeah. So essentially, the reverse repo facility is an indicator for excess liquidity in the marketplace. And when the Fed pumped so much QE into the market, there was literally so much cash that people had no idea what to even do with it. And so they were basically just giving it back to the Fed. And in return, the Fed was giving them, was paying them for this. And they were paying them whatever the prevailing rate was basically in the market at that time, 5.5 or 5.25%. And as the Fed began to do QT, and Janet Yellen issued, whatever the trillions of dollars in treasury bills, that all began to drain. And that led to the reverse repo facility basically draining to where it is right now.
Yeah.
Now, the interesting thing is that repos and the Treasury general account are a liability on the Fed's balance sheet. So when the Fed's balance sheet is, when the TGA and when reverse repo facilities are rising, they're draining liquidity out of the system because it's taking up balance sheet capacity, and banks don't have excess cash to lend out. And when the and basically this darker blue line here, and basically when you look at this blue line, you'll see that this blue line trades very well with the S&P. Now, it separated a little bit during this period of time because the reverse repo facility was draining, and it was keeping and basically helping to boost the equity markets as a lot of this liquidity came out. Essentially, banks had more margin to lend. And now you're at a point where the repo facility is basically drained. There's really no more money, there's no more excess liquidity in the system. And you're looking at a scenario where the TGA is going to rise back up into this area. And with no liquidity offset, reserve balances are going to start coming down again. And that should really drag, equity prices down with it, as banks have to pull back on that.
So they have to raise cash by selling equities?
Well, I mean, they have to raise cash by doing something. I mean,
Okay.
we live in a world where, you have three options to basically go and raise cash, right? You can sell equities or you can sell bonds. But the thought process is that if the Treasury is going to issue $1 trillion worth of Treasury bills, that money needs to come from somewhere to fund that needs to be funded somehow, and that cash needs to come from somewhere. The question is, where is it going to come from? And with no more reverse repo facility to drain, my thought process is that this is going to show up in the form of tighter liquidity and higher repo rates, and that's going to be a drain on equity prices. And so you can watch basically repo by just looking at what the SOFR rate is every day. And the SOFR rate, if it's rising, indicates that the overnight rates to finance and borrow are getting more expensive. And when it's getting more expensive, it's an indication of liquidity getting sucked out of the system.
Okay, Mike, could this also have impact on what's happening with the dollar? We put in a low a few weeks ago, had a nice pop. It's pulling back in here. Does a dollar shortage play into this? And with what sovereigns have to do to raise money, do we have a crowding out kind of situation with the Fed dominating, the Treasury dominating the need for funding?
I mean, it's possible. I mean, this is a Swiss franc US dollar 5-year cross currency basis swap spread. And I mean, you can see that when it's rising, it's a sign of easing dollar liquidity, basically, excess liquidity in the system. And you can see more recently this started to turn and things are starting to tighten. I mean, they're still very loose. And you're still far from where you were in late 22 and 23. But what it's showing you is that the dollar funding is getting a little bit tighter, a little more expensive. And you're really seeing that across, multiple types of currency pairs. This is the euro. It hasn't really recovered at all since early March. And this is the yen. And that also is, showing some signs. Oh, that's the forward rate. Sorry.
So last August, it was a yen carry trade unwind, and you're talking about, we're talking about thin market conditions where bear raids can be very successful, and maybe this August it's a repo scare that a lot of people have to go to the discount window.
Yeah,
is
so
that what
basically, basically what I'm thinking is that this year going into the end of September, between now and the end of September, we could see a decent amount of liquidity sucked out of the system due to the Treasury refunding and refilling its general Treasury account. And this was the spike you're talking about.
Yeah, right.
And this was in the repo facility at the Fed. So the Fed has two different facilities: the reverse repo facility, where the Fed takes cash and in return pays an overnight rate. And then you have the standing repo facility, which is basically where the Fed is taking collateral and giving back cash. And so when there's a liquidity shortage and the overnight funding rate goes over 4.5%, an institution has the ability to go to the Fed standing repo facility and get excess cash for overnight, and then the next day return that cash. to fund whatever operations they need. So
They don't like to do that though, because they're paying a higher rate. And isn't there a stigma?
no,
A bit.
I
No?
don't really know if there's a stigma. I think you're thinking about the discount window, which is a little bit different than this.
Okay. All right.
This isn't, I mean, the discount window, first of all, well, we don't really know those details all right away, but you can see that the standing repo facility hasn't really been used in a very long time.
Yeah.
And essentially, the idea is yes, you're paying a higher rate, but the idea here is that so that you don't have like those 2019 type of issues where the repo rates were going all over the place. In theory, if there's a shortage of cash, they should be coming to this window, this operation, to be able to get that cash to fund whatever it is they need. But more importantly is that once you start seeing activity and it's really starting to increase, that's really an indication of, liquidity strains taking place in the market.
Any way for you and I to get in line in front of that window?
No, it's not open to ordinary people like us. only primary dealers and large hedge funds.
What a high compliment. We're ordinary.
Right.
Okay.
Exactly.
Anyway.
Well, I mean, you can watch all this stuff. I mean, the repo facility prints at 115 every day, and the standing repo facility is at 145 every day.
So what's actionable about all of this? You'd be lightening up on long positions.
I would say, I would say that I'm not antsy to buy anything in stocks at this point.
Okay.
I'm more than happy to kind of just see the, the market cap weighted index, which has just really become Nvidia at this point. It seems like, go without me. I'm not buying anything new at this point, unless it's sort of outside of the really, high flying, if it's like I would say that I'm looking for things that are more defensive at this point. And if it's something that's more defensive and valuation really makes sense and the chart looks decent, then that's different than, I think, chasing some of these high flying tech stocks that you really have seen, go crazy.
How about any duration in bonds that would, or would you be an avoider of
I'm sort of
all bonds?
Well, I don't really ever buy bonds, but I mean, I certainly, what I'm writing about and talking about with, in my subscription services and write-ups that are public, is that I think rates on the back of the curve can go higher still. And I think that ultimately, I think the long end probably isn't really a great place to be. I use like a stock like Wingstop a lot of times as like a liquidity gauge. And it sounds kind of silly, but this stock, I mean, it just really seems to always be.
You know that I had wings 5 nights in a row last week? It's amazing you bring that up.
But if you look at the stock and you compare it to Nvidia, I mean, it has like this weird, look to it that, there's just something about it to me that every time I start watching this thing going up, it's sort of leading the charge. And when it's coming down, it's leading the charge. If it would probably be lower if it wasn't for the fact they reported earnings and the stock went up like 26% in a day, but you can see it's given back a lot of it.
Yeah. Wingstop. Really, that's interesting.
Yeah, I think it's just more of a sentiment.
Consumers still going out and spending, you spend what, about $2 a wing at a restaurant.
Yeah, I guess.
So anyway, there is Wings Wednesday here on Highway 101
okay.
in Encinitas if you want to meet me. Anyway,
boy,
I'm hungry now, Mike. So, all right. So you wouldn't want to buy stocks.
No.
Anything, is this an environment to spec short against the highs at 440? Or do you think we have a new high coming in SPX?
And the SPX, I mean, you mean 640?
No, 440 is a high. from last week. We had that key reversal,
Oh,
and now we're all the way back to
you're
it
talking
right in
about,
here.
okay.
Yeah. Yeah, if we
Um,
take that high out, yeah, then you are talking probably 66.30.
yeah, I mean, uh, the thing is about last week, which I thought was odd, was that when you look at this, you have this bearish engulfing candle on the
Yeah,
weekly,
yeah, yeah,
and most of the time when you get these bearish engulfing candles on the weekly, they're pretty good. I mean, here, I mean, TradingView does it for you. You don't even need to do anything. I mean, here's a bearish engulfing pattern.
yeah.
This time it
That was big.
didn't work, and we ended up getting another one. This one worked. This one worked. This one worked. This one worked. This one. I mean, this one didn't work, but I mean, the majority of them have tended to work. And so I was really surprised that the market, that they were able to take it up last week at
Yeah.
all.
I look at
Obviously,
while you had that chart crunched up a little bit, Mike. Take a look at the downtrend in the RSI. So compress it again like you had it before.
oh,
All right, so the high in the RSI looks like it happened right after that's the high. And when was that? That's in March. Yeah,
that's an
gosh,
March of
that's a long,
24.
that's a pretty long-term divergence.
Yes, it is. And I mean, we got, a lot of people will tell you though that you don't usually get two big sell-offs in the same year. Maybe,
Yeah,
I guess. I mean, we don't have to go back to the lows, I guess, but yeah, no, it's a pretty big long-term divergence. And even when you look at it, it's on the weekly chart. And even when you
same.
look at it on the monthly chart, I mean,
Yeah, same.
you can make the same kind of argument. That's
Yeah,
back in 2018.
yeah,
So, the market's been, I think the market that's why I think the liquidity piece matters so much, because, if you look at, the latest FINRA data, a lot of the reason why we went up was because of, margin rates. I think margin increased to over $1 trillion, which isn't a huge number when you think about the percentage of the market cap of the S&P, but it kind of tells you that a lot of what we've been seeing taking place is really due to the increased amount of liquidity in the marketplace, and not so much anything else, I think, because I feel like a lot of what we're seeing is also taking place in the options market through zero DTE and things of that nature.
yeah.
So, the question becomes, if liquidity starts coming out, does that really start having a meaningful impact on, where price goes? And I think historically it shows you that it does. And, with multiples back to kind of really high levels, it really creates an argument for potentially lower stock prices. I mean, that's really the hard part that you kind of come across, and you kind of left with trying to understand. I did this chart last night that I wanted to see if I can pull up and show you. Oh, here. So this is the margins in the S&P, but I'll get rid of this for a second. But if
That's
you look at
pretty.
the
Yeah,
P ratio, and then you look at the averages, you see that we're back to the highs on the P's.
right.
And if you go back to, 1999, 2000, it got up to 24 and a half. So, I mean, at 24 and a half, the S&P would have to get to 7,000 for that number to work.
That's where I think it's going eventually. But I don't you think if we do get a correction, Mike, do you think it's be garden variety 5 to 7%? Take us back to 6140, the old previous all-time high, or a little, or
I
would
think
it be
it could be a
deeper?
little bit. I think it could be
Deeper.
a little bit deeper
Okay.
when you look at it from a technical standpoint, because
Maybe go for some of the gaps it has underneath the market.
yeah, like, I mean, there's a gap here at 6,000, but I think
Yeah.
this is the one that I would be looking for
Yeah. 56,
more
57.
so, because I think that lines up with,
Halfway
here.
back.
Yeah.
Yeah. That'd be a great buy down there for a move to 7,000.
But what I want to show you was this, because what's happening here is that, in 2000s, you were getting 17, 18% earnings growth, right?
Yeah.
In 2022, 21 rather, you're getting 22% earnings growth. This year, you're only getting 12. So you're paying the same multiple for lower growth. And so all this, crap about how, we're getting all this growth out of NVIDIA and blah, 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 blah. I mean, we're getting really below average growth rates, and you're paying an above average multiple. And so I don't.
Is AI starting to feel like .com to you?
Yeah, but it feels a little bit scarier because this involves, they're spending so much money on this stuff that I almost feel like they're spending so much, you better hope it works.
Okay.
And the thing is
and it's who is it going to work for?
Well, that's
I
the
don't
question.
think it's not. Yeah, it's not. I don't see it working for the average working American.
Well,
at all. They'll be displaced.
Right, but I think the other thing is I use like ChatGTP, I use Gemini, I don't use Perplexity anymore because I don't think it's very good. But I can't really tell the difference for most tasks I use it for.
Yeah.
And so what makes a product worth what it's worth if you can't really tell the difference between two different products? And so if Gemini and ChatGTP are essentially, let's say, a very comparable product, are you really, if ChatGTP is $100 more a month than Gemini, and you really can't distinguish the difference between the two, why would you use ChatGTP? And so if you're plowing all this money into something and it basically, it becomes commoditized like every other technology, then you've just wasted, all this money. And what's really kind of, I guess, what I wonder about is, Meta has burned through tons of cash, and now they just had to tap the debt markets for like 29 billion to basically fund their next data center project. So anyway,
yeah, because they were so cash rich. I mean, have they stopped their buybacks?
No, not that I'm aware of. I mean, they only have like I say
so
only.
They'd rather go the
like
debt market. They'd rather go the debt market instead of stopping buybacks. What's that make you think?
It makes me think they're really gambling on the future.
Yeah. I tell you what, Michael, it's always fascinating to have a talk with you, and I encourage people to go to your YouTube channel, check out your reports. They're outstanding. And what's the best way for people to get in touch with you that are interested in, hanging out with, a smart guy?
I have a Substack called Navigating the Market. And then I publish on Seeking Alpha website under Mott Capital Management, and I have a subscription service there called Reading the Markets. And then I'm on Twitter under Michael Mott CM, and on YouTube as well.
Okay, Mike, are you accepting managed funds from people?
I run so what I do is I have an agreement with Interactive Brokers.
Okay.
And so if people like my investment strategy, they could invest in the Interactive Broker advisor platform where my strategy is available. And basically every time I make a change to my portfolio, it basically copies over. I make the change in my portfolio there, and then it copies over all the accounts that are associated with me.
Okay. Costs involved for that? Is it like, most
I think they
people
charge
get
they charge
2%.
75 basis points per year.
That's cheap. Okay, because a lot of people, they're 2 and 20, and
no,
stuff
I don't run on
hedge fund
space. I just do flat management fee.
Oh, okay. Well, check Michael out. I don't think he'll get caught next year in the bear. I think doesn't it feel like we still have some time to go in this bull market after this big run from April. Just doesn't seem like it. We could turn the battleship around without some distribution taking place.
Yeah, I'm not sure about that.
Okay,
I
so
mean,
maybe they've even got me where
yeah,
back.
I'm just not sure about that. If
Okay.
my thesis is correct, it's going to probably happen a little sooner than later.
Okay. So that's what I'm thinking. One good cleanse, and then one more melt up, and then it's over. But
Right.
man plans and God laughs.
Yeah, I think it depends on your time horizon, maybe.
Yeah. All right, buddy. Well, great talking to you, Mike. And I hope you have a great, the rest of the summer is good for you and your people, and we'll get back together in the fall and
Yeah,
see
sounds
what's
good.
happening.
Looking
Appreciate
forward
you
to that.
coming in. Appreciate you coming in and sharing your, hard-earned insights with us.
Thank
Thank
you.
you.
Not a problem. Bye.
All right. All right. Mike Kramer, everybody. Follow him on X at Michael Mott CM. And Mike is a pretty sharp guy. So that's going to be a wrap for me, everybody. Okay. You can join the team in 14 minutes on the morning edge. And remember, don't just count your pips, count your blessings. See everyone for Turnaround Tuesday. And the gold break was caused by the full moon. Okay. Blame it on the moon. Okay. We'll see. Maybe we're going to have some successive topping action. And maybe we get hit in S&Ps this week too. All right. Take it easy, everyone. Adios. You're welcome, AJ, Laura, Saloom. Thank you. Oh, Saloom. People that are about to retire aren't shorting the market to blow out their retirement accounts. I don't know where your source is, but they're long. People don't short the market. We're a minority of people out here that trade both sides of the market. So most retirees hope you're right, and I hope they know when to get out, because there will be a time, as there always is. Adios, everyone.